Welcome back to 15 Minutes of Finance. My name's Brandon. I'm a CPA, and I'm going to help you keep more of your money. Today, we're talking about real estate investments, and we're going to talk about a couple different levels of real estate participation that will make a very, very large impact on how much of your real estate losses potentially you can use to offset your other income, and what some of these tricky standards or loopholes are that allow you to reach these different levels of participation, which ultimately the conversation we're having is how to convert your real estate investment losses from passive to active. That way you can offset your other income like interest, dividends, W-2 earnings, all of those things, rather than being stuck with these passive losses that you can't utilize to offset income and they're not helping you on your tax return. So that's what we're going to be talking about. Let's talk about the first level, and this is your very passive real estate investor, okay? So if you have a property that you have, tenants in, maybe it's a year contract, maybe it's a 2-year contract. You'll often see this with single family residences, although it can apply to multifamily units as well. And you get a check every month. They're largely responsible for the maintenance of the property. You obviously have the mortgage, the real estate taxes, and you're paying for all those things because of the tenant rent that you're being paid every single month. You own a real estate rental, and someone pays you rent. The IRS refers to that as a passive activity, okay? So that's what we're trying to get away from. That's the first level that a lot of people find themselves in, and people are constantly trying to figure out how they can escape this situation, and here's why. Particularly in the first couple years of a rental unit, right? You have maybe large furnishing costs. You probably have listing fees to find your first tenant. You might have paid for things like background checks. You have depreciation. You have mortgage interest can be very high in those first couple years. You have all of these expenses. A lot of times, even if on paper you're breaking even, your tax loss due to things like depreciation can often be negative, right? But a lot of people can't do anything with that tax loss because it is considered a passive loss. And because of passive activity loss limitations from the IRS, you can't use passive losses to offset active income, which is your investments, which is your W-2 salary income, right? Pretty much all the ways that you're generating income. There's very little passive income that most people have that they can utilize their rental passive losses to offset. It would pretty much be other passive activities like equipment rental or other maybe better performing real estate in your portfolio that has actual income and net income that you can offset with your rental loss, or things like passive holdings in companies like a partnership interest or an S corporation where you're a passive owner who has a K-1 statement. You can use that real estate passive loss to offset that income, okay? It's things that are reported on Schedule E of your tax return, okay? That puts you in a position where a lot of people don't have partnerships. They're not owners in a partnership. They don't rent equipment out, right? We're talking about a pretty short list of the types of people who have this income. So they can't utilize these losses and they can't offset their other income to get a larger refund. So we want to escape this situation. Now, one thing I'll say that applies to these people as well as a lot of other people in these categories that we're about to talk about. So this applies to everybody. So I'm going to talk about it now. One of the provisions, and when things get closer to passing, I will do a full episode analyzing the current budget bill that's making its way through the government. I'm not going to do a really large full episode on it until things are a little bit more crystal clear, because with lobbying and going back and forth, the bill could look very different than it does right now, right? So it's called the One Big Beautiful Bill Act, very Trump-like in the name of the legislation. So the One Big Beautiful Bill Act, or it might just be the Big Beautiful Bill, something like that. The One Big Beautiful Bill Act, one of the big provisions that they want to do is to extend and basically renew the 100% depreciation rule. So for those of you maybe who weren't business owners or rental property owners, back in 2017 for the Tax Cuts and Jobs Act, one of the things that was passed was 100% bonus depreciation, 168 code depreciation on assets, a big category, a lot of different categories of assets where instead of buying things like machinery and equipment or a new deck on your rental property that would be depreciated for maybe up to even 15 years, the 100% bonus rule allowed you to take 100% of the cost of that asset in bonus depreciation in the year purchase. So it really, really helps you accelerate expenses for your business, your rental properties, things like that. That's relevant to even the passive investor. So just something to know. If you're a real estate investor, you have rental units, this is something that would apply to you. It also means if you've never heard of something called a cost segregation study, that's going to start to become more relevant here if this bill passes in mostly its current form, because when that 100% bonus depreciation rule goes back into effect, it's not able to be taken on residential property. Okay, so your whole house, you can't buy a $600,000 house and get a $600,000 deduction. You're still going to depreciate that house over 27.5 years, which is the depreciable life of a residential residence. Okay, but when you do a cost segregation study, you can say, well, that's how much the house itself costs, but what about these kitchen cabinets? What about this deck? What about these storage units? And you can segregate the things that, well, that's actually not part of the structural home. That's furnitures and fixtures. That's machinery and equipment. And now those assets can have 5 or 7 year lives, which in general is going to help you because it's going to accelerate the amount you can take each year, because now you're taking a fifth or a seventh of the cost of that asset instead of a 27.5th of that asset. But when 100% depreciation rule gets renewed, if it does, now not only are you getting 1/5 of it, because it's now not part of that residential unit category, you can get 100% of it in the year of purchase, which can be very, very impactful of the type of expenses you can create for yourself as a rental operator. Now, let's talk about the second category of people. So we're going to talk about people that are able to create their rental income as active. And now that if there's a net loss, they can use that to offset their other active income from any of their other ways that they generate income. So this is super, super important. There's 2 ways you can qualify for it. The one is being called a real estate professional by the IRS. Now you might be thinking, I'm not a real estate professional. I don't have my real estate license. Not so fast. Here's how the IRS defines it. You have 2 major tests, and you and your spouse together can qualify for this. It gets a little bit complicated, so I'm not going to go into the exact specifics of how that happens, but just know that if you hear this test and you're not sure if you yourself, but your spouse also contributes, you still might be eligible for it. You should talk to a CPA. So there's 2 major tests. You have to spend over 750 hours in the tax year on real estate activities. And you can look at, the IRS gives a list of activities that qualify as real estate activities. And then you have to spend more than 50% of your working hours in the given year on real estate. So I can't spend 750 hours, but I'm also grinding my CPA job where I work 1,200 hours during the year. I would not qualify. So I have to both work 750 hours, and it has to be more than 50% of my working hours. If you're thinking, how do I substantiate it? That's a great question to be asking. You should be logging your hours throughout the year, because this is a little bit higher of an audit risk. It's a totally legitimate thing. This isn't like a shady loophole, but it will require substantiation if you're challenged. If you have 5 rental units and you're creating a $50,000 loss and functionally erasing your W-2 income, getting this huge return on your taxes, they're going to want to make sure that you actually are spending all your time, or more than 50% of your time, working on a rental activity. So those are the main 2 tests you have to pass. Now that you're a real estate professional, what does that mean for you? Well, there's a box now on your tax return where it says real estate professional, and now all of that activity is going to be seen as active income or losses, okay? So this does 2 great things for you. One is the whole point of the episode. It means that if you have a rental loss, which on paper a lot of people do because of depreciation, Now you can offset your other income. That's almost certainly going to increase the refund you get or reduce the amount that you owe when you file your taxes every year. That's awesome. The second thing that's really cool is that it's going to open up a new world of expenses that you can write off. This is now an active activity for you. You can write off things like home office deduction, like mileage to and from these various properties. You can deduct a portion of your internet and your cell phone bill and things like that, of what portion you use for this business activity of rental income. Okay, so now you've increased your write-offs, right? That gives you a higher chance of having a loss. And then when you have that loss, you can now actually utilize that loss to offset your income to increase your refund. So you really want to get to the point where you're a real estate professional. But I know I'm talking to a lot of people that are not real estate professionals. There's a lot of people who have rental income. It's not 50% of their life, right? The whole reason you buy rental units is to create passive income for yourself. It's not your full-time job. It's not even your primary job, right? So a lot of people are going to fail that test. Are you just left in the dust? Well, not quite. There's one more way that you can qualify for the second level of treating your rental activity as active instead of passive. A lot of people call this, it's sort of what's the word for an expression, but it's wrong. I don't remember. Anyways, the sort of idiom now that has been created is the STR loophole, the short-term rental loophole. It's not a loophole. It's referred to as a loophole because largely this legislation from the IRS was written for places like hotels, but it applies to other people. And so they see it, it's like, oh, it's a loophole for you. It's not really a loophole. It's just the IRS couldn't have foreseen how massive these companies like Vrbo and Airbnb would ever become. And so, the IRS didn't necessarily foresee it applying to so many short-term renters. They saw it more of as a corporate thing for things like hotels, but you can take advantage of it. That's awesome. So the STR loophole, the short-term rental loophole, the IRS says that as long as you meet one of these tests for active participation, very important there. If you Google this, do not Google material participation. That's very different. They only require active participation, which is a different and lower standard. It's sort of like in a court of law. Do you have to prove reasonable cause, or can you prove beyond a shadow of a doubt, right? There's different standards. Same thing here with the IRS. You don't have to prove material participation. You just have to prove active participation. So if you do that and the average stay of your unit is 7 days or less throughout the year. So it's okay if somebody stays for 12 days, 15 days, as long as your average stay is less than 7 days a year and you meet one of these rules. That allows you also, because of the short-term rental loophole, to write off your losses as active instead of passive. So here's the participation tests, okay? And there's 7 of them. You can look these up to keep this brief and also to talk about what's relevant. Most people are only going to use one of these first 3 because they're the easiest to meet. So I'm going to read those 3 for you. 1, you can spend more than 500 hours on the short-term rental business. 2, you can do substantially everything for the short-term rental business. So that means you don't necessarily spend 500 hours, but you also, nobody else is managing the property. You're doing everything. Or 3, you spend more than 100 hours on the activity and no other individual spends more time than you do. So as long as you spend 100 hours and nobody else, there's no property manager, there's no full-time maintenance guy that's spending more than those hours. Those are the main 3. That means you meet the tests, and what happens? Well, you can now get what is called the short-term rental loophole, so to speak, treatment, and now your rental activity is active instead of passive, allowing you to offset your other income and increase your tax refund. Very, very powerful tool, okay? And you've also hit the same standard where this is now an active business, and that means that you can write off extra expenses and increase those losses on your taxes. That's awesome. Now, we're getting close to 15 minutes here. Let's talk about the third type. Now, I've talked about these people before, so I'm going to talk about this less, and this is someone who has active how would I say this? You actually work in the capacity of a real estate agent or a real estate professional. This would mean that you probably get 1099s and you're performing real estate services and getting paid for it. That puts you in the third category where you actually have a trader business. You now aren't on Schedule E, you're on Schedule C of the tax return, profit and loss from a business. And now, similar to the other type of people, you get extra write-offs because this is a legit business activity, but now you get an even extra level where you are actually a business owner as a professional real estate business. And so this allows you to do one extra thing that I'm going to talk about. There's a couple extra things. For example, you can now write off the self-employed health insurance deduction. There's now certain vehicle deductions you get access to. And my personal favorite for people who want to be aggressive about their investments, you now qualify as a business that you can have a solo 401k plan or a SEP IRA that allows you to put a lot of money away very, very aggressively, including Roth. So most people can only put the maximum in their Roth IRA of $7,000. Well, as a solo 401k owner, you can contribute the maximum deferral, which is $23,500, and you can make Roth deferrals to your 401k plan. So you get the same end result, which is Roth contributions, meaning in retirement, all the money and all the growth is completely tax-free in retirement. And instead of being able to contribute $7,000 a year, you can contribute $23,500 a year. And even on top of that, you can have employer matching contributions to put potentially $20,000 or even $30,000 or even $40,000 away, because now you're actually running a trade or business as a real estate professional. That's the third level. Now, there's one downside that I'd be remiss not to talk about here. When you reach this third level, like if you're a real estate agent or you're managing 27 rental properties, you're being paid a management fee, you have a business of rental properties, you now are self-employed. So if you aren't at a loss, if you have net income for your business, you're now going to have self-employment taxes of 15.3% on top of income tax on your earnings. So those first two levels, we're talking about income, whether it's passive or active, but neither of them are employment income. If you are seen as a business operator as a real estate professional, now you're subject to self-employment tax. So if you have significant gains in this area, this could end up now being actually a bad thing for you. So you should tax strategize with a CPA. It might even be worth considering being an S corporation tax owner to help prevent some of these self-employment taxes. There's a whole episode a couple weeks ago, I believe it's a 2-part episode, on S corporation owners and how it can save you on taxes. So if you're in this third boat, it's definitely worth planning beyond just it being active. You need to make sure that you're not recording a lot of net income, or at least be aware that you're incurring self-employment tax in addition to the income tax that you're paying on the income as well. Well, thank you for listening to another episode of 15 Minutes of Finance. I hope you learned something about real estate activity. There's 3 levels to it. It's either passive income, it's active income because you're a real estate professional, or you're managing short-term rentals, or you've reached the third level, which is it is an actual business for you, and you should utilize that for both the tax savings as well as the long-term investment planning. The very, very powerful tools that you're able to utilize as a small business owner. As always, share this episode with friends that you know that have real estate investments. This can help them save on taxes every single year. And as always, invest early, invest often. We'll see you next time.